Thanks for having me.
Clinton Wilkins with Centum
Home Lenders
Home
Limited.
Lenders. Yeah. And tell us a little bit about yourself.
I've been a mortgage broker for 16 years. It feels like yesterday. I don't think there's probably anything else that I could possibly do in my life after 16 years. I'm sure some of you guys have been in the industry just as long or longer. And there's been so much change, which I think is really interesting. And that's what's really kept me motivated over the years. It hasn't always been boom. We've certainly had some hard times over the last 16 years. So I've certainly have experienced that. I'm sure some of those of you in the industry have experienced it too. It hasn't been at this level forever. And I think it's a very challenging time to be in real estate. I think the end consumer thinks, realtors just open the door, put a sign up, and they're getting a paycheck. It's like going to war is kind of how I tell the consumer. And a lot of our clients who even have pre-approvals are getting fatigued because it's so challenging. You know what I mean? And I really do feel that. When I started 16 years ago, I was fresh out of university. I'd never worked in banking before, but I'd owned some rental properties with my partner at the time. And we were using a mortgage broker, and I'd asked the mortgage broker for a job, but he didn't think it was a good fit. I didn't have the experience. So I'm just going to do this myself. And then 16 years later, here we are. And since I've been with Centum Home Lenders, which is a franchise business, I've been with them for 13 years now, and we've done over $1 billion worth of mortgage funding. So we're coming up on 5,000 transactions. So in this market, for a team, we've done the most. And we compete on the national level, which is really cool. You would think in Halifax, how can we compete? Our mortgages are so small and our real estate values are so small. And we really compete on that volume, and we just have so many clients. So for example, last year we did about 830 transactions, and that'd be made up of obviously purchases, refinances, renewals. So we're certainly seeing a lot of transactions, and that gives us a little bit more buying power in terms of maybe the rates, but also we likely get better service than maybe the bank branch gets, or maybe another broker down the street, because we have the volume, so we're able to do a little bit better sometimes, I will say. And I think the experience, really, that's the big piece. The experience, we've seen so many different things. Imagine doing 5,000 transactions. There's so many nuances. And I think every transaction, every consumer is kind of like a snowflake. For us, it's made up of income, it's made up of assets, and it's made up of credit. And there's not one right path, which is kind of cool. It's what works today based on the snapshot in time. And every single consumer can get a mortgage. So when you guys have clients that get declined, every single one can get a mortgage. The challenge is there's two things that'll be impacted. Obviously, if it's a harder file, they probably need a bigger down payment. And the harder and harder it gets, typically the cost of borrowing goes up. But every single consumer can get a mortgage. It's just, do they have the willingness and the ability to maybe come to the table with more skin in the game, is the way that we always say it. So we don't decline anyone. The consumer just may not be able to proceed based on what they can get. So we typically say we can do every transaction.
The coin in the pocket.
Yeah, exactly. And I think sometimes the coin can be the biggest challenge,
Absolutely.
especially in this market. We're certainly seeing consumers that are coming with six-figure down payments, as you can imagine. They need sometimes 20% down just to get into the marketplace. And we're seeing family gifts of $100,000 plus. So that's really been a big shift for us in the last couple of years. I would say majority of the people that we had pre-approved.
You coming up? Come on.
Hello. I think the majority of the people that we had pre-approved, 5 years ago, they were high ratio purchases. They were 5% down, the minimum. And that's really, there's been a big shift in that. If you have 20% down, we can typically get pretty much any deal done, especially if it's in Metro. Because if it doesn't work with the bank, it can maybe work with a trust company, or maybe an alternative lender, or a mortgage investment corporation. So the 20% down is kind of the magic key, and we're seeing less consumers doing the high ratio purchases. Just because obviously you need to have an extra layer of approval there. And, some clients just don't qualify. The government has very strict debt servicing requirements when it's a high ratio insured mortgage, and there's no exceptions to that. So, but we can always get an exception when it's 20% down. There's always a way to do it.
How are you feeling about where the interest rate is headed? Where do you think it needs to level?
Ooh, this is a really good question about like where are the rates going and
Yeah.
what do I think?
We know they're not going down.
Here's the funny thing. We talk about like bonds and like what's going on in the bond market because obviously that's what impacts fixed rates. And we only ever hear about bonds going up. You never hear when the spreads get better. You only hear when the spreads are worse and then they have to increase the rates. We are big believers in a variable rate mortgage product. Historically, consumers do better in a variable rate. Even if we're looking back over the last like 30 and 40 years, the variable rate mortgage product has been better. Right now, the Bank of Canada is really in a bit of a storm. We'll use this very politically correct, due to what's going on in the inflation. We're at record high inflations and they've had to sharply increase the key overnight rate to basically stay the inflation. I'm sure you all see it at the pumps. The cost of fuel is up. I have a diesel SUV. It cost me $177 the other day to fill that up. So they're increasing the key overnight rate to help consumers be more motivated to start saving and stop spending. And the goal is that they're going to bring the inflation down. Some economists think that they're going to be at the key inflation targets by the end of the year. And some economists think that we may be in recession territory in the next 12 to 18 months. So I think the rates are going to go down. So for those consumers thinking that a variable may be more risky because there's going to be some increases, the fixed rates are very high right now. So a fixed rate is somewhere between low to mid 4% range. When I started 16 years ago, a fixed rate was 6.25%. I'm sure some of you remember when the rates were higher than that.
We won't age ourselves.
Yeah. And a variable rate was, prime minus 90. The prime rate was somewhere, around 6%. So consumers were getting a rate at 5.1, and the spread between 5.1 and 6.25 was huge. And then the prime rate went down to 2.25. So those same consumers had a rate at 1.35, and their cohort that were in a fixed rate were at 6.25. So as you can imagine, there is a lot of movement specifically tied to the key overnight rate. And so to summarize, the next 12 to 18 months, we're going to see some increases. That is reality. If a consumer can't, weather the storm for $30, $60, $100 more a month, they are probably in over their heads. Those are the consumers that really should potentially be taking advantage of the higher, values and getting the listings. Those are the ones that past clients that are we're having a bit of a hard time. These are a perfect time to list, or we are seeing a lot of consumers doing midterm refinances. Sometimes the rates are still very good. There might not be at historic lows, but they're still very low. And, Canadians are really kind of addicted to this cheap money, and the money is very, very cheap still. So I think that's a consideration. There's always going to be consumers that are in financial hardship. It doesn't matter what's going on. It doesn't matter what's going on with inflation or the rates. You're always going to have some of these consumers that are going to reach out to you for help. And there's nothing dishonorable from selling your home. In a lot of cases, the consumers, their biggest asset is their home. And obviously the mortgage is their biggest debt. So I think those things are, considerations. We are doing fixed rates for some consumers at 4.5% because they can't sleep at night knowing that there could be increases in the variable, even though they know that it's going to be cheaper. But when we really look at it side by side, at a variable rate at 2 point something, let's say 2.7 compared to 4.44 on a fixed, there's a big spread in the interest borrowing cost, and there's a lot of runway for the Bank of Canada to increase the key overnight rate for it even to be at parity with where the fixed is. Variable is always cheaper, and friends don't let friends take a fixed rate.
That is your motto. Do you have a specialty focus, something that differentiates you from other lenders?
I think the big thing for us is we are brick and mortar. So we have 2 locations. We have a location downtown at 5151 George. Some of you may know that as the old main branch for Bank of Montreal. So we're right on the main level there. And our original location is over on Wise Road at 99 Wise. which is the big West office hour. So we really believe in brick and mortar, and we bring a lot of our consumers into the office. I think we talked about this kind of before we started. Like, we're seeing customers, and I think that is a little bit unique in this industry. We love doing things over e-sign. We love, doing things over email. But I think the one thing that we remember is, buying this house is a big transaction, and the mortgage is a very big financial transaction. There's a lot of moving parts. And we really believe at bringing clients in, at least to sign the final documents, because then we can go over all the nuances, explain the rate, the product, the terms, the payment frequency, the payment dates. There's a lot of these nuances. Yeah, the penalties, yeah, like there's so many differences, and you would think that, with mortgage lending, everything, is very consistent. It's not. It's very different. And that's why I think unbiased mortgage professionals like us are just so important these days, because consumers can walk into any bank branch. Like, I was just up at, Harvest, and there's a Scotiabank right next door. We deal with Scotiabank every single day, but the experience for a customer to deal at the branch compared to us, even though the product is the same, sometimes can be very different between what we're able to do and the pricing piece. It's a little bit like volume. So where we're doing so many transactions, and I have a couple like ex-bankers in the audience, we do as many transactions typically in 1 month that a normal branch would do an entire year. So we're kind of like Costco, only very, very specialized, and we only sell toilet paper. And I don't think we really sell it all. I don't think we sell. I think we are a service business, and I think that we are an advice business, and it just happens to be that the widget is mortgage lending.
And and I always tell people the benefit of going to brokers is they're not changing around. Like, when we first started buying houses when we were young, it was you go to your bank and then the banker changes, and then you have a question and there's no one to ask.
New advice. Yeah.
Exactly.
And I think I've been in the industry for 16 years. I may have my toe dipped in the 40-year-old pool here in 2022, but likely I'm going to be around for another 20, 25 years. So I think that's very important. And I've been in the same office over in Dartmouth for 13, 14 years. So people know where to find us. And I think that is a big differentiator. A lot of, mobile mortgage specialists with the banks, a lot of other, brokers, they work at home. And I don't want to discount working at home. Obviously, we've changed our culture the last 2 years. But I think it's so important for a place for the consumer to come if they have a problem or if they need help. I have so many people that have a hard time just printing their bank statements. Some people don't have computers at home, and you can only do so much on your phone and on a tablet. Sometimes you need to go somewhere, and then we, can help. The other thing is we have a really great team. We have 3 ladies who answer the phone every single day, where you're not calling a call center when you call us. And we really pride ourselves to answer every single call. Doesn't necessarily mean that I can talk to every consumer, I'm not able to, but at least we have someone who can answer maybe a quick question or at least point them in the right direction. And I think that's really valuable.
Would I be able to ask a question?
Sure, go ahead.
Sorry, hi. Are you able to get mortgage rates on mobile homes? I just heard you mention them.
So currently we don't offer financing on mobile homes in our office. We do also have an office in Moncton. So if they really want to go through the broker channel and do a mobile, we will send it to our office in Moncton. Also, draw financing. So if it's a self-build or a contractor build, we also do not offer that type of financing in our office, but our Moncton office will. So if we have a consumer that wants to go through the broker channel and it's one of those 2 transactions, we won't do it here in Halifax, because those typically are the most time-consuming transactions, mobile homes and draw financing. And I'll be honest with you, it's not our specialty, and I'd rather someone get the super expert advice, because those are very challenging transactions. And I don't like to take on a transaction that I know that we won't be the expert in doing, because we really built our business on advice, and that is a differentiator, and I want to make sure that those consumers get really, really good advice. Mobile homes, I'll be honest with you, if it's a prime customer, they should go to Royal Bank. And I have no problem stating that. Royal Bank is the strongest at mobile homes. Draw mortgages.
Yeah, I just find that their customer service isn't very good anymore, to be very honest.
You're not the only one who said that,
Yeah.
and that's why we do get the calls, I'll be honest with you.
And I wish that there was more, like I wish that brokers had more
access.
interest in mobile homes, because now, for especially a first-time home buyer, out are the days of buying a $150,000, $200,000 single detached home, especially in HRM. So that part is tricky.
Yeah, and honestly, when we do a pre-approval, we really ask the consumer, like, what is the intention here? I've said this on my radio show, first-time home buyers really have to have household income of like 100, 125,000 to get into the market today. Or they have to have a lot of skin in the game. The rule of thumb on affordability is 4 to 4.5 times the annual income. That's what a consumer can afford. So if the average house price is $500,000, what's the math? $125,000 of household income. And it's very easy for us to just look at it to be like, yes, this is going to work, or no, it won't, as presented. But again, if they can do that 20% down, they can go to a higher, maybe debt servicing ratio. The one thing that we do need to remember, in a raising rate environment, customers need to be able to afford the rates. Over the last 4 years, rates were very, very low. So some of these consumers are going to come up for renewal, starting even like right now today. And if they were coming out of a fixed rate at like 1.5%, 2%, they may not be able to afford their lives here going forward. I think there's a big opportunity in the real estate industry to talk to your existing clients. Some of these clients need to be right-sized. Some of these clients need to sell. It's not just about always onboarding new customers. I think talking to the existing, very, very valuable right now.
Can I ask something else?
Yeah, go ahead.
I'm a very new realtor. I only just got licensed in February, and the mortgaging side is not my strong point. But how would I tell a first-time home buyer who's, her specific situation is that her landlord is selling her house, and she definitely can't afford $300,000, but now that she's actually needing to look at rental prices, which are all, $1,200 versus buying a place, hoping to get a mortgage payment around $1,000 and to have that ownership, like, it's a very uncomfortable, almost conversation.
Yeah, and in that case, that consumer might not be ready. I'll be 100% honest with you. And even if we're able to get into the, real estate ladder, I'll call it, they might be getting in over their head. I think with that consumer specifically, if they don't have a really healthy down payment, it's probably not going to work. Or they need to really look in a much more rural area. And that is happening in Nova Scotia. That's one of the really exciting things about Nova Scotia. People, can still afford to buy. Because if you can't afford to buy in HRM, maybe there are some more rural areas of the province that you can afford to, find that house that's $200,000. They do exist. But if you're planning on working in downtown Halifax, the mechanics are probably not going to work, because you're going to be like an hour plus out of the city.
Pricing cats with
Yeah,
your mortgage payment.
that might be prohibitive, right?
Yeah.
So I think in that consumer's situation, I think the real question that you need to talk to them about is, the affordability, the down payment, and are they really ready? Because not everyone's ready.
No, and that's what I was going to ask you. What's the best advice you can offer to the first-time home buyers that relates to their being financially ready?
The one thing that we do, we figure out what we can pre-approve them for at the max. Because I get the emails every day to be like, oh, I found my dream place. I just need like $20,000 more of affordability or $50,000 more of affordability. So we always like to see what is the absolute ceiling that you can afford. This may be above your comfort level, and you may have to eat craft dinner and may not be able to furnish the home. But what is the maximum amount of affordability, so you know? Because we like to give the advice and like lead the situation, but there's so many nuances that we aren't involved in. It's like the negotiation and what is available in the marketplace. And customer situations do change over time, so we're cognizant of this. A lot of first-time homebuyers, they're early in their careers. Chances are they're probably going to make more money. So if we can get them into the real estate market initially, a lot of them are going to be in a better situation in a couple of years, especially if we can continue to see the values go up. I think it's likely unrealistic that we're going to continue to see growth at this level. We obviously need a lot more inventory on the market. We need a lot more starts. We're dealing with a hangover of 20 years ago when HRM wasn't approving building permits. Late 90s, early 2000s, we basically had a moratorium on building. And guess what? Now we're really paying the piper.
Yes.
Right? And it's going to be another 20 years for us to rebuild the inventory. So there's going to be a storm.
I think it's hard too for young people when, say, prime example is, say, two university educated young people at a university, student loans, great jobs, but paying high rent, $2,200 a month.
They can't put money away.
They can't put money away. So I've heard that. I had one son say that they went and got a line of credit, and they used that for their down payment.
That is possible. Flex down is still allowed.
Yeah.
So a flex down, it's a minimum of 5% down on the first 500, 10% down above 500,000. The Canadian Mortgage and Housing Corporation will not allow it, but Sage and Canada Guarantee will. And that's one nice thing with us. We have a lot of different lenders, and we have really great relationships with the insurers as well. So you can borrow the down payment, but then 3% of how much you borrow has to go into the debt servicing ratio. So they'd have to service the line of credit and obviously qualify for the new property. But that is possible. You pay a slightly higher insurance premium because it's a riskier deal. You're not putting your own, skin in the game. And that's why I think we're seeing more and more family gifts.
Yes.
And do they get the capital gain when they sell the house for that 5% they pay? Do they get the capital gain?
No.
So everything is the owner has it.
Everything the owner has, yeah. Now, obviously, we know the federal government has done some changes with the capital gains and the speculative tax, and we're actually getting a lot of consumers that are non-residents outside of Canada, so we can't do those at this time, at least for the next 2 years. And there's some people who are going to be landed, and we certainly do a lot of new to Canada, but they physically have to be here now. So that you can't be buying as a non-resident and be like, oh, I might move. That's not kosher currently.
Can you describe some of the incentives available for first-time homebuyers?
So there's the first-time homebuyer incentive, and the maximum purchase price I should rephrase this. The maximum mortgage amount and the incentive together can only be 4 times their annual income. So for example, let's say the household makes $100,000, the mortgage and the incentive can only equal $400,000. The way the incentive works is on a resale property, it's 5% of the purchase price. So the consumer would put down 5%, the government would put down 5%, and essentially they would have a 5% ownership in the property. That money has to be paid back in 25 years if the property is ever sold or the property ever becomes a rental. On a new construction property, the incentive would be 10%. Now, there's a cap. It can only be 4 times, and the household income cannot be more than $120,000. So it excludes some people.
Yeah.
And I would say in
Those
Halifax,
young professionals.
if they're making above $120,000, that won't work. I'm seeing more of this first-time home buyers incentive in some of the smaller deals. And it doesn't necessarily allow them to qualify for more, but it will reduce the mortgage amount and it reduces the CMHC premium. So the premium they'd only pay on 90% or 85%, depending on like how much they're borrowing. So it reduces the interest cost, it reduces the mortgage payment, and it reduces the high ratio insurance premium. So there are some benefits. The one caveat I will say, some people got caught up with this. The break-even point is about $100,000 of price growth in the property. So Who knows what's gonna happen to values?
Right.
But if the next year is any indication of the last 2 years, maybe the incentive today is not the best solution. Also with the the home buyers plan, we can't forget about that. So the home buyers plan, 35,000, each consumer can take out of their RSP tax free, and they have 15 years to put it back. And starting in 2023, the federal government has announced a new TFSA saving vehicle that will have a tax benefit, and consumers can start using this new vehicle to save towards their down payment as well. It's kind of like the TFSA now. They're only allowing so much to go in each year, up to a maximum dollar amount. The reason they're trying to make this slow and long is they want to hold back some of these first-time home buyers from entering the market. So they want to basically give them 5 years to continue to save and make sure they're ready. So
it's a protection.
It's a protection plan, I think. So 35,000 from the RSP tax-free, and they'll have this new TFSA vehicle. It's something to bump up in some of these markets, because in our market, I'm thankful we still, our average house price is around $500,000. In Ottawa, it's over $900,000. In Toronto, it's like double that. In Vancouver, it's double again. Above $1 million, you cannot get a high ratio insured mortgage. You have to put down 20%. So I think in our market, we're going to see some growth between that 500 and the 999. At least I see the over $1 million is a little bit slower and maybe not as competitive. But yeah, I saw one the other day. It was listed over $1 million, and then it went for a couple $100,000 over that. Multiple offers. Multiple. So anything I say is based on my experience.
Right.
I'm not a realtor. I've never been licensed. I won't be licensed. I did sit on the Nova Scotia Real Estate Commission for 3 years. I was appointed by the province of Nova Scotia, and I actually headed up the education committee when it was first struck. So any of the courses from previous, I probably had my fingers in. So I'm very familiar with the industry and the forums and all these things. And luckily, I get to look at agreements every day.
Yeah.
And I definitely see some interesting things. That could be a whole other. That could be a whole other Zoom.
Yeah.
So another question is, what are some of the challenges for permanent residents to obtain a mortgage? Any points that realtors can use to ensure successful financing?
Very good question. So there's two types of basically new residents that we consider. Either a work permit or permanent residency. If you're on a work permit, you can qualify with as little as 10% down, and the mortgage would then be insured through, CMHC or one of the other insurers. You need to qualify on the income, and the income needs to be very stable, like a salary. We're typically seeing more of those consumers, working for, border services. Like maybe it's a U.S. Border Services person coming here to work in Halifax. That's very easy, clear, and concise. We also see a lot of IT and tech type people that are relocating to Canada. They have a really great salary, and will get their credit or a letter from their bank for whatever country they're coming from. That helps solidify things. And then the 10% needs to come from their own resources. So we certainly see a lot on a work permit. Permanent residency is interesting. If you're a permanent resident, you qualify for the same programs that a Canadian qualifies for. In even the first-time homebuyer incentive, everything is basically the same. If you're newly PR and you might not have the income to qualify for a mortgage, there are some new to Canada programs as well. And typically with those programs, you need to have much more skin in the game. So that might be 35% down. Sometimes the bank wants to see 1 or 2 years of mortgage payments in reserve and savings. And typically you still have to have some income. They want to know you can kind of still pay some of your bills, even though you might not be able to qualify. So they can't be unemployed. But let's say, you have a little bit of credit established. Maybe you've been here for a year and you're a permanent resident. You can qualify for the regular programs as low as 5% down.
And in Canada, we qualify our consumers at a much, we're tougher to.
More stringent.
Right, than what the US is.
Mm-hmm.
Yeah, I've heard that.
We are much, much more conservative. We qualify our mortgages today across the board on a rate of 5.25 unless the contract rate of the fixed is higher than 3.25. And as we know now, the fixed rates are above that. So if you have a fixed rate today, we're qualifying you on your contract plus 2%. So it's actually, as funny as this sounds, it's easier to qualify on a variable rate mortgage today than it is on a fixed. And some consumers are forced to take a variable because they can't qualify on the higher qualifying rate. Do I agree with it? I don't know. For me, it's not a huge problem because we're really a big supporter of the variable rate. But for some consumers, you know, they want that fixed, but the numbers just don't work. So that's interesting.
Yeah.
And who would have thought we would be here? Who would have thought there would have been a pandemic?
Yeah,
I'd say if only we
pandemic,
had a
war in
crystal ball.
Ukraine, you know, like.
I know.
It's that crystal ball we keep asking
I
for.
know. Mine's broken.
Yeah.
I tell people that. They're like, well, what's going to be better? I'm like,
Yeah.
I don't know what's going to be better.
Yeah.
That's just it. Are appraisals affecting the outcomes for mortgage approvals during the past year, and if so, how?
We're seeing very few appraisal gaps, which one would have thought would be a huge problem. It is not.
Yeah.
It is not. Reason being, we still have a lot of transactions to compare against.
Yes.
In a raising price environment, it can be challenging because it's based on comparable sales. The appraisers are making it happen though. You know, they're digging out even some private sales. I think the appraisers are working very hard, but more and more transactions need an appraisal. Even the insurers are appraising properties more.
Yeah.
And we do have automatic valuation systems that we use, but the percentage above assessment, the percentage above the list price, the, you know, square footage in the postcode, like all of these things impact that automatic valuation system. And less properties are kind of going through because, as we know, some of the purchase prices are just wild compared to even like where the list is.
I really figured year one when this all started to go crazy, I thought, okay, the appraisers are gonna settle this right down. That was my really gut instinct when things were first coming. It was like, nope, they're going through. So once that happened, and now there's more and more
You know,
comparables to put to you.
Yeah, the comparables are really, really key. And every time there's like a new sale, I'm like, there's a new comp.
Yep.
And I'm surprised sometimes. And probably some of the ones that you saw in the news, we might have done the financing for. I can think of like some very, you know, notable ones, potentially like semi-detached in Eastern Passage that might have gone for like crazy amounts. I'm like, there is no way this is happening. There is no way. It happened.
So do you think some people will be in trouble once the tax,
Down the road.
or once the tax, you know, department catches up with the prices?
So
Start reassessing.
I got earful from an old retired counselor, politician, we will say. Property valuation services has not caught up. They are going to be years catching up with the market value. Typically, they run 2, 3, 4 years behind anyway. But we are going to see a lot of growth in the assessments over the next couple of years.
I think there'll be some hiring to do it.
It could potentially happen. And also, HRM is increasing the tax rate. So it's almost like a double whammy.
Yeah.
October, I think, is going to be an eye-opener for some people when the tax bill comes out.
Even this year, it did.
Oh,
A little
well,
bit, yeah.
my own cap went
Right.
up, and it's almost reached my assessment, my cap, and I'm like, so my neighbor sold their house for so much more, is now my house all of a sudden is gonna be up there
Yeah.
too, right?
It's really based on the sales.
Yeah.
It's really based on the sales. And we are trying to decouple as many mortgages and tax accounts as we can. On a high ratio purchase, the bank is required to collect the property taxes. But on a conventional mortgage, they will trust the borrower to pay the taxes on their own. And I tell the borrower, if the bank will trust you, take them up on it. Because many consumers are going to be in a shortfall position in their tax account, which means their account will be in overdraft, and the bank needs to collect enough to bring the overdraft back to zero and make the future bill. So that we're going to see some major increases in mortgage payments, which, you know, if the rates are up, and let's say you're in a variable and your payment's up, and the cost of goods are up, it's going to be another little fuel on the economic fire. I did think it was interesting yesterday, the province has rolled back their property tax for non-residents. So I think that's very interesting. I can tell you, we got a lot of calls from across North America. I got, emails from people that I know in Toronto to be like, what's going on in Nova Scotia? And I think in theory it was good, potentially, but a lot of these homes are not homes for first-time home buyers.
No.
They're homes in Lunenburg County that are seasonal. And, the family that inherited this third generation $1 million cottage can't afford $20,000 more in property taxes. The one gap that the province didn't think about, when these people come, they're spending their money here in Nova Scotia. And I think the amount that they were trying to kind of regain, they might lose really if this would happen. So very interesting, and I really followed that one closely. I think the federal level, stopping the non-resident buyers, so like outside of Canada, I think is going to be potentially more effective than this tax scheme in Nova Scotia was going to be. So we're going to wait and see on that one.
Yeah, absolutely. What are you seeing right now for mortgage preferences? Fixed, flexible, closed, open?
It's 99% is closed. Yeah, 99% is closed. Typically in Canada, about 60% of Canadians take a fixed rate. In our office, it's inverse. About 60% of customers take a variable. Reason being, I do a lot of work with the Bank of Canada. I do a show on City News every time the Bank of Canada meets, so we're very involved in that. We also like do a live stream. And all of our customers that are on a variable rate mortgage get an email every time the Bank of Canada meets, and we have them set up to get a little SMS. We send them a little blast notification. And any of you that we communicate with over email also potentially get a message that you're able to share with your customers and for you to be, informed, which I think is super powerful. We like to pride ourselves to get the word out before it's even available on the news. So we watch the announcement, like we are in lockup with the whole media thing, and we watch online. I was actually in Chicago during the last announcement, and I had Amanda and our communications guy on the phone, and I'm like, we were watching the announcement live, which is really cool. But then I give my perspective to the consumer and obviously our business partners and let them know kind of what's going on, to be like, I think we still need to stay the course. A lot of people are thinking the sky's falling because of the rate increases. I can tell you the banks are calling all of the consumers that are in a variable rate and telling the consumers, these rates are going to the moon. You want to know why? They are salivating for consumers to lock in at 4.5%. Salivating. And I think anybody who's in a variable now needs to remember, you took that for a reason. Lower short-term interest rates, there's going to be some change, but the flexibility of the variable is just so superior. You can break the mortgage early and it's only 3 months interest. If you break your fixed rate early, I've seen some $20,000, $30,000, $40,000, $50,000 penalties breaking a fixed rate early. A lot of things change in people's lives. Health issues, financial challenges, divorce, marriages, relocations. And just imagine, if you need to break that mortgage early, you're breaking it for a reason. But you don't want to get maybe a little slap going out the door.
Or a big slap.
Or a big slap.
A big slap.
And just think, let's say that you were in a fixed rate when they were low. Let's say it was 1.99. And you're coming up for renewal today and it's 4.44. That is going to be a lot more sticker shock than a little micro increases on that variable. The variable is safer.
Can I ask a question about the variable?
Go ahead.
So you can lock in a variable rate, correct?
Yeah, you can convert into a fixed rate at any time with the lender, and there's no penalty. And if you were to convert, it would be at whatever the rates of the day would be for the remaining term. So let's say there was 35 months left on the variable rate mortgage, you would have to lock it in at least to a 3-year fixed.
Okay. So someone could sign up for a variable mortgage and then the next day decide to turn it.
Convert. Yep, and there would be no penalty.
Okay, that's good to know. Thank you.
You still be committed to a fixed. And
Right.
then any of the terms and feature the fix, then would apply.
Yeah, I assume that you can't just flip flop and be variable this week.
You can always go to fixed. You just can't go the other way.
Yeah. Okay.
And in this environment where a lot of consumers have so much equity, we're seeing definitely more HELOCs now than we used to. It was very, very popular in the early 2000s. And then I think a little bit after that, the subprime and kind of the meltdown in the US, consumers were more wary of HELOC because it's basically kind of enabling you to debit off your house and using your home as an ATM. But because consumers have so much equity now, a lot of existing homeowners, we are seeing adding HELOCs or a mortgage component that has a mortgage and a HELOC involved. And some of these consumers are using funds on their HELOC to buy a down payment or use it for a down payment for a second home or a rental property. So that is very interesting. And if you're an existing homeowner, your net worth went up. And just and circling back on this,
I guess it did.
I've over doubled.
Well,
Yes, I've doubled.
And somebody said to me, like, I've owned like almost 20 properties in my life since I was like 19 years old. And one of my neighbors just sold their house. It was when I bought it, it was a new construction in 2001 or 2. And I bought for $169,000, and they just sold for like over $600,000. So like more than tripled in 20 years, which is pretty interesting when you think about it. And you can't think about like the what if. It's all about that snapshot in time. But when we're talking about parents giving kids gifts, I just want to circle back on this. If the parents owned a home, they benefited from this increase in the property values. And I think that's why some of these parents are willing to kind of give bigger gifts right now, because their equity went up. And I think they think that, if their kids don't get into the market now, they may never be able to get into the market. And that's why I think we're seeing a lot of these gifts. And we're certainly doing some transactions for parents to, put a mortgage on their home that's free and clear, or a HELOC, and then gifting those funds. I actually just had one like this week.
It's really hard when you have 3 of those kids.
And you may give me
You're stretching that.
you can just go hustle and sell a few more properties.
That's what they think.
That's what they think, exactly. No, the hustle is like paying the bills.
I'll just go sign you and just pay the mortgage.
Yeah, exactly. No, they probably want you to pay too.
Sure. Oh, yes.
Oh.
What are some things that we can do as realtors to help with the process on your end?
I love it. That's
Tips
such a
and
good
stuff.
one.
Yep.
That's such a good one. We have so many great like realtor partners, and there's so many great realtors out there, but as you can imagine, there's a wide range of experience and kind of like attitude and all this stuff. Typically what we ask for every time we get an accepted offer, the realtor view of the listing cut. So that's the one pager with the vendor's information at the bottom. We want the executed agreement. So that's fully executed, everything filled out correctly. And we want the property tax bill. Most listing agents already have the property tax bill uploaded. So usually that's easy. It's not always there. So that's one thing we always come back for. Many lenders today also are asking for the PDS.
Yeah.
More and more. I was never asked for a PDS in the
No.
last 16 years, but the last like couple of
6
years,
months, even the last 6 months.
I would say the last couple of years. I'll tell you why. In this increasing environment, they want to know if there's problems with the house. If there's anything shady on the PDS, I've even seen lenders come back and ask for the inspection. If you condition for the inspection in there, they have the right to ask for anything that is in that agreement. So if you don't want to give the PDS up, if you don't want to give the inspection up, don't have it in the agreement.
There's just plenty there waiving all that.
Trust me,
They're usually
I'm
waiving
just
you
like,
too.
I'm like, it shocks me.
Yes, yes.
Like I sometimes sit up on my desk and I'm like, I am very concerned because the ones that waive the financing are the ones that should not waive. The ones who put the financing condition, I'm like, these people could be approved anywhere. It shocks me. And I think it's a lot of first-time home buyers that are waiving. Those are not the ones that should waive.
No.
The people that potentially could waive their financing, guys, are the people that can put down 20%. Because if it doesn't work with the bank, we can do an alt lender. If we can't do an alt lender, we can do a private lender. If you need less than 20% down, you need to put a financing condition in, because not only do we need to get this past the sniff of the bank, it's also the insurer. And this could be a client who's fully pre-approved, it's ready to go. But it's not just the client, it's the property. The property is the piece of the puzzle that we do not know when we do the pre-approval. And sometimes the properties are trash.
Oh, yeah.
I've seen
And
them.
if we're waiving financing, and they need financing, we're not telling the truth. And
I don't know if it's
we're
not even,
not giving you a date
But,
to
like,
work with.
what happens if we need an appraisal? I've seen
Yeah.
vendors be like, nope, there was no financing condition, they're not coming in.
That's right.
That is problematic.
Or
That is
just flags
problematic.
it that I gave you this lovely clean offer.
And now,
Well,
And now you got an appraiser going, oh, well, we just wanna see if we can do it the other way
If I see a
too.
waive on financing, I'm assuming it's a cash offer.
Right.
So I'm asking that person, is this cash?
and so when we get a
Good
bridge,
question.
so if we have to do a bridge
Yes.
and there was no financing condition on the other one, we want proof. Because the bank won't give the bridge on the sale if they aren't firmly, so we either need the financing letter or we need proof of funds. And that, I think, becomes a privacy problem, because like I don't want to know about somebody else's offer 3 offers down the road.
Right.
Oh,
Yeah.
like I don't care what's going on with them. I just want to know that it's going to happen. But I get asked from consumers that are very, very strong to be like, I don't want to put an SOPP in.
Yeah,
That's another one.
Kills you right
I'll
now.
tell you what we do. You need to put in a financing condition, or you need to do like a longer condition date, like 7 days, 10 days. Once that offer is accepted day 1, the sign better be going up on the other house, because we know how fast things are moving.
That's right.
Because if you're having problems selling the other one, you still at least have that 7 or 10 days for the condition dates on the first one. So customers are scared not to have an SOPP. I'm confident when it's a strong buyer, and you should be confident if you're also listing their home, because you're even more motivated to make it happen if there's going to be something else that's rotting on that. I do get that question asked a lot. They're like, well, what can I do to protect myself but also make this attractive? And I always say, lean on your realtor. The realtor will give you the advice. You know, in my opinion, this is what we're seeing. We're not seeing SOPs unless we think it's a very problematic situation. Or sometimes maybe like new construction, but then at that point, like, who cares?
Yeah.
I'd love to talk about new construction if anybody's curious.
Absolutely. Go right ahead, because I'm pretty much with
Wow.
my moving into tomorrow.
Wow, on new construction is all I have to say. The problems are endless. Not just because we're in a raising rate environment, but if the dates get pushed out like 1 day, the rate can reset. And you're seeing a lot of problems like weird price increases,
Yeah, that's.
a lot of delays, a lot of new construction just falling apart. I used to think like new construction was the easiest. New construction is the hardest right now. I'm much more confident in resale properties, quality, value, etc. I think it's a safer transaction. I think it's safer. I do think though, a consumer typically makes more money on a new construction, because usually when the markets keep on going up, we have some consumers that are doing refis 1 year and owning their new construction, and they have a couple $100,000 of increase. So it's interesting, but there's definitely some challenges with new construction. Definitely some
And there's a
challenges.
few developments that the province has pushed for them to be approved.
Oh
So
yeah, well,
there's
because I think there's 20,000 new building lots, I think, that have been
There was
constructed.
the Port Wallace project that they put on the back burner for so long.
And they were like, now it's like, let's
Yeah.
go.
We're going,
Well,
good to go.
gonna have to, good
So
for
I
some
live in
houses.
that neighborhood, so I have people asking me continuously
About it.
that.
We are really big believers in turnkeys, obviously because we're not doing draw financing, but I think a turnkey is safer for the consumer. The people are like, well, I'm going to save on the deed transfer tax. That is the least of your worries, people. That is the least of your worries, because you have the carrying costs on a mortgage on a draw, plus anything can go wrong. We know there's challenges with materials. We know there's challenges with labor. With a turnkey, it's on the builder to deliver that product, and you're not paying. It doesn't close until they deliver you a finished product. I think turnkeys are the way to go. They still could be a custom build turnkey. That's cool. But we're definitely even not getting the inquiries for draw financing that we used to. I mean, there's no lots to buy.
Yeah,
That's right.
Yeah.
and then you have builders with a turnkey that say, oh, you signed at 650. Oh, by the way, that's now gonna cost, well, we can't guarantee that'll cost you maybe over 8, and then the people are approved for,
But people are they're what they want. They want the consumers to walk away.
Yeah.
They want them to. So like we've
And
had
give them back their deposits usually too.
usually, yeah.
or some won't.
Some won't. The ones that want to resell it for a higher price, they are usually very motivated to give the money back. But some of these builders,
I've seen
yeah.
them.
well, some of these
Take everybody
builders are
else.
going to bankrupt because,
Yeah.
they feel bad because they're like, I'm building this house at a loss. And they're like, they can only do so much. Their pockets are only so deep. Even the biggest builders in Halifax, we've seen them go under. The biggest.
And they shouldn't be not profiting. No one's into the business to
To break
not-
even.
You have to break even.
I just think there's some
Yeah.
unsavory practices,
Mhm.
and that's tough as a licensee to be able to navigate that for your client, right?
It
Or
is.
maybe if your client is a builder, that's tough to navigate that too. I just want to throw it to the Zoom. I know we were like talking. I can talk about mortgage lending for hours, so we can stay here. But our friends on Zoom, I just wanted to open it up to see if you have any questions.
I was actually just wondering if you could possibly either Marlene or Vicky could send us your contact information via email. And want to thank you for all the information because it's the little nuggets that we pick up that we wouldn't pick up maybe for a year unless we hear it from you. So thank you for that. Something else that I've heard as a realtor and things that we can do to kind of better the process. I like having that conversation because that builds partnerships and trust and that great relationship. Is even like, the one in Eastern Passage, I enjoyed that very much, how she, that whole process of the house and Smokers Haven and all this. So even the description we have to keep an eye on as realtors, do we not? To kind of make sure that we don't overindulge or we don't say it's a shithole, really, to be honest with you, because that could affect, could it not, the insurance and the whole process of mortgage?
100%. Did you see me on CTV?
No, I wish I did. I'm going to Google you and creep you though. I'm interested.
Trust me, there's lots. I was actually in Toronto in meetings, and Frisco texted me. He's like, "Can you come on the air?" And I'm like, "I'm in Toronto, but I can do it over Zoom." He's like, "I need you immediately." And I'm like, just went on. I'm like, I personally would not buy this house, but it's probably a good investment for someone. And that one went under list. I think it's firmed up now in the system. I haven't looked lately, but
Yeah.
I think it was listed for 260 and it went for slightly under. Though that's the type of home that would have sold for like 150,000 a couple of years ago.
I
Yeah.
felt bad
I think
for
they
that
rushed
For
and just
seller,
took a
for the elderly
sale.
lady. I felt bad, yeah.
Well-
I think they just took the sale, right, just to get all the
Yes.
news.
Yeah, and whatever's in the description, guys, the banks do read, just so you know. I've seen issues with like zoning that's not been correct on the listing or the square footage of the main and the total. So when we put our numbers in, if the numbers are not right, we take what's off the listing cut, even though sometimes what's on property valuation services is not the same. So sometimes things are like way off. So be super careful when you're doing the listing that's accurate. Because there's obviously that can be a challenge. Don't use the word hobby farm. That will kill pretty much like every deal. So we'll often come back to the listing agent and we get them to edit the listing before we change
Send
it.
that through, yeah.
So because I've been around so many, I can call somebody and be like, "Hi, this is problematic. Like you need to like change this." But a lot of people that are in the mortgage industry would just run with whatever's there. So like I'll look at it and I'll read it before it goes because I'm really the gatekeeper. I want to make it happen just as much as you guys want to make it happen. We don't get paid unless we lend people money. I do understand that. I really think like we will be your biggest advocate, and every consumer should really seek the advice of an unbiased mortgage professional, whether it's us or whether it's another broker, because we do have more options. And I think there was one person on the Zoom to be like, I don't think the customer service right now is great at the branch with Royal Bank. All of the branches are going through major challenges. Huge staffing,
Yes.
COVID, they're run ragged. During the last 2 years, a lot of branches were closed or had reduced hours. They would send the customers to us to be like, Clinton is a trusted source. He's a known entity. He will take care of you. And I would do them with TD Bank, Scotiabank, like they would send me the customers. And we would domicile the client to their branch because we had the manpower and the systems and the processes to do it. I don't necessarily think that we are like the second chance lender, but if there's ever a situation where you think, hey, I'm not sure if this customer is being given the right information or, has explored all the options, we will always look at it. And we will tell you straight out to be like, yes, you have something here, or no, you don't have something here. Because like the skill set of different people, there's a wide range. And just like licensees, there's a wide range of experience and ability. Same thing in the mortgage industry. I think with us, we're just more motivated, obviously like you guys, because, it is like career sales. We are motivated to make it happen, and we want to make it happen for every customer because we don't think we make a lot of money on the first transaction, but where we really make our money is the repeat. And that's really what we go for. So
And it's important, same as us, it's all about that.
it's all about the repeat. Any other questions?
Sherry, I think you're on mute, love.
Yes, as usual, not aware of my my mute button. First, thank you so much. And Jen had commented, all the little tidbits that we get, and it's very, very true. So first, I want to thank you for talking about the variable and fixed rate mortgages, because I'm somebody who was very risk adverse and had always done fixed rate, and then decided to do variable rate mortgage on the last refinance. And honestly, my little heart's been jumping in my throat watching the rates go up because I don't like risk. And anyway, so this made me feel a lot better about that. So thank you. I'll be sharing that with clients.
You will be okay. And if you want to email me, I will get you set up under Keller Williams, and then you'll start getting information that a customer will get even. So
I would really, really appreciate that. I also appreciate the insights that you're offering in terms of new home construction. I have been telling my clients about doing turnkey, but I didn't really understand why. Simply for me, it was always like a stress reliever. Like, you don't worry about this till they hand you the keys is all I knew to tell them. So having a little bit more info was great.
For sure.
Yeah, no, I absolutely appreciate that. And I actually do have someone that I think I would like to refer over to you guys. So I really would like to have your contact info, because I am in a situation with them right now where I'm like, oh, okay, I think maybe you need some additional hand holding and additional information that I honestly don't believe he's getting at the branch, to what Flynn had said about customer service. I've experienced it myself, and it's what kind of always makes me come back to brokers instead of going to a bank.
Well,
and
I think
banks, but
I mean, we need the banks. They're a big piece of what we do every day. Like a big portion of what we do is bank deals. Like, let's be honest. I think the one thing that you touched on there, I mean, you've experienced it, but everyone in this room is self-employed, right?
Yeah.
And, self-employed people sometimes have a roadblock with the bank. They might have had a bad experience before. They've been told no once, and they could be the most prime client, but not everyone fits in every box. All right, guys, thank you very much.
Thank you very much.
Thanks for having me. Thanks for having me.
Thank you.
And we have
Appreciate it.
Thank you.
Guys,
For everyone, we have a couple little packages so if you want to drop by.
just pop in and grab one off the table.
Okay, you're gonna have them on the back table where everything usually is? Okay.
Yeah, we'll stop it.
Okay,
All
thank
good.
you.
I'll stop the technology.
Lynn's
Thanks,
Mr.
guys.
Technology.